Hello, welcome to the Victor H Investing live stream. It was a significant day yesterday on Wall Street with stocks going down significantly, and I wanted to have another live stream to talk about it. The Nasdaq went down significantly yesterday and had the worst day it's had since 2022, and that was a big down day for the Nasdaq. The S&P was down as well, more than 2%. It was down 2.31%, and that was a pretty big drop for the S&P. And the Dow slipped through with about a 1.25% drop. So it was a pretty down day. And we've had, I think, if I'm counting right, 4 down days out of the last 5 trading sessions. So that is maybe we're seeing that investor sentiment has really gone down. I felt like for a while, I don't think it was completely out of control, but stocks kept going up and there was a lot of enthusiasm around stocks. And I began to get worried that stock prices were a little too expensive, and a good pullback was probably good medicine for the investing community to take. And here we have it. We've had maybe the first or second dosage of medicine to get these stock prices down a bit. The big market cap stocks, they were not a place to go and hide. Apple was down 2.88%, Microsoft down 3%, Nvidia was down almost 7%. Google announced good earnings and they were down 5%. Amazon down 2.99%, and Meta was down 5.6%. So it was a pretty good down day across the board. When we look at the sectors and industries that were down, semiconductor had been really heated and it is down. It was down collectively 6%. So it was a pretty bad day for semiconductors. Internet content information, which is where Google, Meta, Netflix reside, it was down significantly. The one bright spot is Spotify, which is one of my favorite streaming app for music and books, audiobooks. And I don't do too many podcasts on it, but I'm just addicted to it. I can't live without it. I love it. So it did really well. It had really good user growth and it did well. The software category, which Microsoft's the biggest player there, it was down. Consumer electronics is down. Now, drug companies, pharmaceutical companies, it was a place for safety yesterday. So companies like Pfizer, J&J, they actually went up, which makes sense because they're a little bit of a contrarian play. Internet retail was down, but not as bad as, let's say, semiconductor. Banks went down, not too bad, but it went down. Application software was down. Insurance did okay, down 0.33%, not too bad. Oil went up slightly, which was a very good day yesterday, considering that stocks fell so much. Regional banks went down. Biotech was a decent place to be, depending on the company that you're invested in. I think we looked at Novartis yesterday. Novartis would have been probably, and here it is. It was a place a stock that went up. Looking at other green areas, utilities, which is a place where it's safety, was a place to go up. So it was a pretty down day yesterday. And it's not, in my opinion, right? And from my perspective, it's not terrible news. It's just a good sign that, hey, stock prices are not supposed to go up consistently up and to the right. There should be points when stocks that are just priced too high get reduced. And it's a good signal to see that, hey, we're going to have some of that reducing. Now, the stock market's never perfect, and at times it'll reduce the price of very good companies. And there lies the opportunity for me to see companies that I really want to own get really discounted, and I buy. So I'll go over the stocks that I bought today on the live stream. I'll talk about that in a little bit because I did do a fair amount of buying yesterday and buying into companies that I want to own. So it was a gloomy day looking at some news that came out that I think is interesting and may affect stocks is that the US economy grew at a pace of 2.8%, which is fairly good. It's not a boom period, but it's growth, which is really unexpected and interesting. It's a number that could probably sway sentiment of investors thinking, well, the economy will continue to improve. It's doing fairly okay now. So, what will happen with interest rates? Um, Interest rates, if the economy is growing and we don't have any job losses, the Federal Reserve's not going to be highly motivated to reduce interest rates, which would then, put a little more stress on small caps. It'll keep bond yields higher. It'll keep the yield on cash higher for longer. And those things are, I think, positive to have a balanced market where investors, especially fixed income investors, can invest in bonds. They can sit on cash a little longer and make a good return. So that was interesting. I wanted to note that. So another area, and I see the comments coming in. Thanks so much for joining. I'm going to get to your comments in probably another 2 to 3 minutes. So hang in there with me. Thanks for joining Quags, Earthbound Misfit, Shadow Guy, Sergio, Quags, and then Mike, the dividend investor guy. Thanks so much for joining. Give me a few minutes and then we're going to get into your comments. So the other thing I wanted to put out there is I'm showing a graph of the Dow compared to the S&P, compared to the NASDAQ, compared to the Russell for the last month, and see if we've seen some movement in, where stocks are rising. And there certainly is. We saw the small caps, the Russell 2000, really made a move in the last 30 days. It really rose at let's call it the second full week of July. And that was a move that the expectation for lower interest rates really caused a big move for small caps. So small caps are beginning to work. Will it sustain that? Is it a head fake? That'll be interesting to watch. I'm watching that because, I do have investments in small caps, but I've been cautious about small caps because they've been underperforming for about 2 years. And if they underperform, I'd rather be in performing stocks or in cash or in, an investment that's going to be low risk and give me a yield, because some of these small caps have really, it's just been kind of dead money. And in some cases, the small cap, stock has gone down in value. So I'm going to watch that. It was good to see it rise, but it didn't continue to rise. And today's news that the economy is doing well, and if inflation, excuse me, yeah, if interest rates are expected to stay where they're at, that's going to put pressure on small caps. So I'm going to watch that closely. The other thing that I'll point out is the Dow outperformed the NASDAQ and it outperformed the S&P. And the Dow is made up of 30 companies. These are very well-known companies like Microsoft, Home Depot. These are really well-known companies. It outperformed the other exchanges. So just to point that out, I don't think they broke any records, so I won't comment any further on that. So that's what's going on there. All right, so we have earnings, and we had big earnings earlier in the week. Google probably being one of the bigger names. Tesla really melted down. They went down 12%. But I think the sentiment is pretty cautious. I know with Google, I like their earnings. They grew 14%, their revenue line. I think they did invest more in the business, so their free cash flow is a little lower. But it's such a valuable business. Geez, I bought $1,000 of shares yesterday on the drop. Thank you very much for the discount. I bought Meta stock yesterday, about $1,000 in Meta. Those are my two biggest positions. And when those stocks drop like that, I'm a buyer. Comcast announced yesterday, and their earnings were not great. So the stock price, I believe, sold off. And, that's a company that's kind of caught, with one leg in the past, one leg in the now, and I'm not sure it's going to work out for them. So we'll see what happens there. Looking at today, I think by now AbbVie would have released their earnings. It's 6:10 a.m. Pacific Standard Time. AbbVie should have announced. They announced before the market opens. Then Union Pacific. I've been interested in Union Pacific for some time, but it's always hard to get a good acquisition price on Union Pacific. It's really important for me to buy into that company at the right price because the stock won't move a whole lot. And I think that the stock was somewhat run up over the last couple of years. So I'm tracking that stock. I'd like to take a look at that a little later. Tomorrow, 3M will announce, and that's a stock that I own. So I'm going to be watching that closely. So that's what's going on. Now let me get to some of your comments. So the Quags, good morning, sir. Good to see you. Earthbound Misfit, good morning, man. Good to see you. Sergio, how are you, sir? What are your thoughts on a company like FXC? So let's take a look at FXC in a few minutes. I'm not familiar with the symbol, so let's take a look at it. Mike, the dividend investor guy, opinion on F, great dividend. Okay. So I did want to look at Ford. Their stock is crashing. They announced their earnings, and let's take a look at that. We'll look at that one closely. We'll look at their earnings release. We'll look at their financials. We'll look at evaluation and really drill into that one. I think that one will be interesting. And then second comment from the dividend investor, AbbVie. Interesting. So AbbVie, I'd like to take a look at AbbVie. I have owned AbbVie. In the last 5 years, I probably owned it 3, if not 4 years. It's a good dividend payer. Some of their patents are expiring, but they are replacing those patents with some good medications. So we'll see if that works out for them. But I'll take a close look at that one. So, yep. So thanks, dividend investor guys. So let's get cracking with FCX and see what that one's about. So Freeport McMoran. Okay, so these guys are a mining company, and they explore for copper, gold, silver, and other metals. All right, sounds good. They are a $63 billion company, and their revenue is $23 billion. They pay a small dividend of 1.36. Analysts say it's a buy, and it's discounted by almost 22%. So I think mining stocks right now, looking at where we're at, right? It's 20. I think the economy is set to grow more. I don't think we've had a booming economy. So I like mining stocks. I own TX, and that's my mining stock. I used to own BHP, and I was happy with the return on BHP. I sold BHP and concentrated my investment in TX. Let's take a look at this one and see what it's all about. So we have on the financials, and I don't expect mining companies to have these beautiful upward trends because they depend on commodity prices. In the case of this company, they're depending on gold prices as well as other commodities that they're mining for. So if those commodity prices drop, their revenue is going to drop. It's not that they're doing something bad, but they're just, dependent on those stock price or commodity prices. So you see that the earnings or the revenue has gone up. They've had boom periods, and then they have periods of dropping, especially in 21. Wow, what a growth rate. That looked really good. They probably acquired a company or something. So the growth is acceptable. When we look at their free cash flow, their cash flow is all over the place. There may have been a boom period for gold or something in 21 because that's a huge number. Now, their free cash flow doesn't excite me. 1.4 billion, and for a mining company, I'm not going to give them a big multiplier because it's a mining company. It's going to be cyclical depending on where commodity prices are. So if I multiplied 1.4 billion times, let's say 15, I'd get to about 21 billion is the guess on a market cap, and they're well above that. So this is not producing a lot of free cash flow based on their market cap. So I'm probably not going to value this one at a discount. I'm probably going to value it at a premium if I used free cash flow. If we look at earnings per share, analysts are, I'm going to say, optimistic about the stock. They think it's worth a lot more. There's 10 analysts that cover the company. They think it's a buy. And if we look at their earnings per share, they're expecting to really grow earnings per share. You see this growth rate of 30% this year, 36% in 21. So that may cause some, momentum in the stock, which would probably make the stock perform. If we look at the 5-year chart, it's kind of been going sideways, so to speak. It's had a recent rise and then a drop. This stock here doesn't overly excite me because that free cash flow is just too low. I'd probably disqualify it based on the free cash flow. So take a look at it. I hope my comments were interesting, and good luck with this stock. Let's take a look at Ford. So I am a Ford stockholder, and it's not going to be a pretty day. Oh my gosh. It's down 13.39%. We are 14 minutes from the market opening. So it's a really bad, it's going to be a really bad day for Ford stockholders. The market cap is 53 billion. If we look at the 5-year, for some reason, somehow the stock market just decided we don't like Ford anymore, because if you look at the rise that we came out of COVID, it just kept rising. It was really nice to see the stock rise. And then ever since, it had a significant drop that, this peak was at the beginning of 22. And then a lot of stocks dropped in 22. So not only Ford, but ever since then, it's just really has not done anything other than pay a decent dividend. So this one here certainly has been a stock that I own that has underperformed, has been a disappointment. It'd be nice for Ford for the stock price to have more momentum, but what are you going to do? The stock market's going to dictate that. Things I like about Ford is the growth rate for Ford is good. You look at their sales of revenue, their growth of revenue is very good. So I like that about the company. If we look at their quarterly, we see growth, green on the screen. So that looks good. All right. And when we look at free cash flow for 23 was very good. 22 was negative. They invested a lot in the business, but you can see they've had some really good numbers out there. I would also bring out this point that if you compare Ford's free cash flow and compare it to Tesla, which is a massive market cap, Ford produces more free cash flow than Tesla. And that's one of the metrics that I use for my valuations, which I'll show you in a minute where I value Ford. So cash flow is good for Ford. They've been growing their revenue. I think their lineup of cars is really good. They sell really well, especially their ICE vehicles, internal combustion engine vehicles. And their EV lineup is good, especially their truck. Their truck is set to really sell a lot of units. They have the best selling electric truck in the US. And they have the number one selling ICE vehicle, which is their truck in the United States. So they have certain models. They're just really high volume. I like that about Ford. But the market isn't overly excited about car companies, with the exception of Tesla. So this one here, I don't have a massive investment. I'll take a look at how much I have invested in a minute, but that's where we're at there. Analysts, there's 13 analysts covering the stock, and they say, hey, it's discounted by 6.51%, but after today, that'll really move toward 20% discount. And the earnings per share, it's going to be flat for the most part. So not a lot of growth on earnings per share, right? So, all right, so let's jump into my own analysis and see where I think Ford ought to be priced. And before I jump in there, I like covering the desirability quadrants, right? Where I want, ideally, I want stocks that are in the green. These are stocks like Google, Meta. They have huge competitive barriers. Even Union Pacific, you could say, is in that quadrant because it's very hard to compete against these companies because they either have really good competitive barriers, they have technology barriers, they have adoption barriers. Like in the case of Meta, there's billions of people that have active accounts, but Ford is not in the green. Ford is really in the gray. And the reason they're in the gray is that obviously there's many car companies. Now, is it easy to start a car company and start competing against them? Not really. I mean, it takes a lot of know-how, capital, brand, dealer network. All these things take years. Ford's been around for more than 100 years. So it's in the gray, but it's not in the red. I don't want to be in the red. The red means that you're buying a business that's competitors can easily enter that market. They come in, there's too many competitors, so prices are really beaten down. Profits are beaten down. There's no cash flow. If anything, there's negative cash flow. So I don't like buying in the red. I love buying in the green, and I carefully, strategically buy in the gray, and Ford is in the gray. So looking at the valuation for Ford, and I'm going to need to update my stock price because we know it's going to drop big time. So let's take a look at this. The stock price is going to be $11.80. So looking at their cash flows they're guiding that they're going to do $6.5 billion of free cash flow. And they reiterated that guidance. So they said, hey, we're going to do that number. It shouldn't be very difficult for the company to produce that kind of free cash flow. So that's good. So the cash flow is going to be very good. And second, so based on that number, I'm forecasting that they're going to keep that free cash flow and continue to grow it because, again, they have a very good lineup. They have very high unit sales for their models. For example, the Bronco is a very good selling car, and it's an SUV. And when you have high volume, you get to make more money, and because you really spread the development costs, engineering costs, all the costs that went into making that model get spread out over many, many more units. So it's more profitable and you generate more cash. So I'm optimistic they're going to grow their cash. In long term, I'm going to be very realistic and say only a 3% growth rate that will put in the terminal value. This is a higher risk company. I'm going to go with a 9% discount. Because it's a car company, things can happen like a union strike or things like that. So it's a higher discount rate. So when I discount this forecast of free cash flows the company is going to bring in, I get an intrinsic value of $112 billion, which is well above their market cap. I add the cash and take away debt, and I get to an equity value of $96.7 billion. Again, and I think this market cap is not correct. I think it should be a little bit lower, but let's correct that real quick. Market cap is 53. And that's not going to be correct. So I'll just leave it as is because I'm not going to be able to do the math very quickly. It's going to be around 49 billion. Having said that, it's discounted significantly, 110% discount. If you look at the cash flows that this company produces, now, earnings per share is a similar story. Car companies, GM, Ford, their PEs are super low. So when I just use a 12, this is a growing company producing free cash flow and grow very, very little. You saw that the growth rate was going to be very low when it came to earnings per share. I get a intrinsic value per share of the stock price of $23, but their stock price is going to be $11.80. So there's a discount if we look at the earnings per share. So overall, Ford's just heavily discounted. If you look at the fundamentals, so that's interesting. Now, I continue to believe in their fundamentals. I like the company. I think their lineup of cars is good, but the market does not agree with me. So I'm going to keep my Ford shares. I don't know that I'm going to be buying more shares. And the reason for it is just there's no momentum in the stock and there's no momentum in the space. We had Tesla lose 12% on their stock yesterday. General Motors sold off and they had a very good earnings. So there's like no momentum in this space. It's kind of an undesirable space. It does pay a decent dividend. So I'm not going to buy more shares. And I'm going to, really think about Ford. Um, I'm not ready to sell it, but I'm not ready to buy more shares. Okay. So those are my opinions on Ford, which was another stock that we wanted to take a look at. All right. So let me catch up on some comments. So, Sergio, in your opinion, what's the best tech ETF to invest in? And let me, I'm not an ETF guy. If I were to go through an ETF search, I probably wouldn't do a very good job. So I'm going to pass on that question and ask that maybe you get a different source on ETFs. I'm more of a pure stock guy, and hopefully you can find a good ETF. I know tech is selling off, so we'll see how far, how low will tech go is the question. All right, so Quags, I like VGT if you're going to pure tech. Okay, there's a suggestion right there for you, Sergio. Maybe that's one worth taking a look at. I like Vanguard because they don't have a lot of fees, which is good. But let's see here. Wow, look at the rise on that. It pretty much follows the NASDAQ. So interesting. All right. Thanks for bringing that up, Quags. Shadow Guy. There's another suggestion for you, Sergio. So I might not be able to help you, but the community can. Appreciate it, guys. Quags. Another good ETF. Cool. All right. Very good. Okay, so Sergio, you're on your way. Thanks for bringing that up. Thoughts on MAR? So MAR, Marriott. Okay, so Marriott over the last 5 years. Look at that chart. Nice chart. Up and to the right. So travel stocks have been good. We were in this pandemic and everybody was forced to go home. And I'm going to use, the point of view of I'm in the US. I know some of the viewers are outside the US at the current time. And once we got out of COVID, especially as we headed into 22, people just started to travel. And I can understand. And there's two things that were going on. A, people really wanted to travel. B, people had money to travel because they didn't spend any money in these 2 years. I mean, we were at home pretty much, saving up money because we weren't paying vacations. I know my car, I went from driving 12 to 15,000 miles a year to driving like literally 2,000 miles a year. So my automotive expense went down, my travel expense went down, my clothing expense went down. If I wasn't leaving the house and I could wear a pair of shorts every day, hey, that's pretty affordable. So we had a lot of money going into these years, and the consumer has been spending the money on travel. That's really benefited Marriott. And looking at Marriott, it's a $67 billion company. Their model is they don't necessarily own the hotel properties when you stay at a Marriott. And I stay at Marriott's, by the way, when I travel and stay at a hotel. I stay either at a Marriott or at an Airbnb. If it's going to be a quick, hey, I'm going to be there for one night, it's a hotel, because Airbnbs are great, but I don't want a whole house if I'm going to be there one night and maybe get there in the evening and leave in the morning. So Marriott is a good brand. 24 billion is their revenue. They pay a small dividend. It's probably small because the stock's been rising, and really If you look at the performance over 5 years, 65% over the last year, 21%, very good rate of return. Year to date, it's only been doing 4%. I think maybe the travel economy is beginning to hit a wall. What's interesting is the airlines have announced their earnings. And the problem with the airlines right now is that they're having kind of an airfare war on prices, and they're really beating each other up over price. But the volumes are through the roof. They've been breaking records of how many people are getting on an airplane and traveling. So that's good for Marriott. The volume is good for Marriott because people are traveling and need a place to stay when they get to their destination. So overall, I think Marriott is in a good business at a good time. Um, the price is discounted based on analyst analysis, and they say it's a buy rating. The market has opened. Marriott's opened down just slightly. How's it done over the last 5 days? So it's kind of been there with the rest of the market. It's down 4% over the last 5 days. Not a terrible, drop, especially if you compare it to some of these tech stocks that dropped 12% in a day, right? Or Tesla dropped 12% in a day. All right, so that looks good. Let's take a look at their financials. See this growth rate? That's what I was talking about where, hey, first the COVID year was horrible, understandably. And then from there, they grew just tremendously, and they've been growing really well. Looking at the quarterly, the growth continues through the quarters. Very good to see. Looking at their free cash flow is okay. Now, it hasn't been growing, which I would really question that. It's like, why aren't you growing your free cash flow? You have more people staying at your hotels. Marriott doesn't own I don't think they own any of their own properties. They probably do a couple, but mainly Marriott is it's like the McDonald's model or where they will partner with whoever owns the property. And it's usually a group of investors that own a big hotel property, and they partner and they pretty much franchise the Marriott brand and everything that comes along with it. Being on the Marriott website, Marriott helps you with reservations and all that good stuff to fill your hotel with guests. So they don't own the properties. So it's surprising to me they're not increasing free cash flow. If you have more people staying at hotels, you're making more revenue, you don't have a lot of capital that you have to put in the business because you're not buying the hotels. You're just modernizing your website, modernizing, the way you do business. So I'd be curious to see why their free cash flow hasn't been growing. At this rate, if I look at their, and am I looking quarterly? If I look at their free cash flow, and actually they had been growing their revenue because I was looking at the quarterly. So if I look at their free cash flow for the year, trailing 12 months, 2.6 billion, multiplied times 20, that'd be about $52 billion in market cap. And they're at 67. So I'd probably calculate that this stock is currently priced at a premium if I looked at their free cash flows. And you can see that the stock has really risen, which is why I would probably say this is priced at a premium. It's hard to get into a stock that is, I expect at some point it's going to come down. The travel industry is not going to be in these good times forever. I think the consumer is going to, at some point, either they get tired of traveling or they run out of money. and then the volumes will come down. So I'd be really careful with Marriott at this time. I don't think there's a lot of upside. And at the same time, I think there's some risk factors out there that are going to bring this stock down. Marriott is kind of in the gray for me because it is a very good brand, and I think people are comfortable with the brand like myself. I know the quality I'm going to get with a Marriott when I travel. So their brand has very good value, but there's hotel competition in every city, right? And they don't have any barrier of entry. The one company that I put in the green in their space is Airbnb, and reasons for it. I've done Airbnb videos on my channel. You can look at them. Airbnb is a big investment for me. I own $140,000 of Airbnb. They do have a competitive advantage, which is they set up a home sharing model, and homeowners prefer to put their properties on Airbnb. It's just in a more equitable relationship with how they rent out their properties for short-term rentals. The experience is different. It's disrupting hotels to some extent. It's expanding the space. Just a lot of good things around Airbnb. So Airbnb is my investment in the space. Therefore, I wouldn't be a Marriott stockholder, but if I had to look at Marriott, I put them in the gray. I think the stock's a little priced a little too high right now. So those are my opinions on Marriott. Hopefully you found that interesting. Quags. Okay, so very good. Yeah, so you make, over the past couple months, right? I began to worry that, and let's take a look at where the markets are right now. And so the S&P is down a bit. Okay, the Nasdaq is down a little bit, and the Dow is up a little bit. The Russell's down big. Maybe that news that the economy is doing well and interest rates are probably going to stay higher for longer. Maybe that's news is beginning to hit the Russell. The thing that I didn't cover is the VIX. The VIX is it rose quite a bit. If we look at the year-to-date chart, I mean, we're up there in the March-April timeframe. We had that, call it 5 to 6% on the S&P pullback, and I think we're nearing that type of pullback at this point in the S&P. We're at that VIX, volatility index, which is the fear index of the market. So investors are operating with a little bit of fear, so we could see pullbacks, and I think sell-offs will be more exaggerated. They'll be much quicker, and drops will happen much faster. All right, so we have the VIX is up, market is trading at this level. Now, the comment that Quags brings up, would you want to, looking at the 5-year for the S&P, right? We had the last real correction in the S&P was in 2022. It went down substantially. I think it went down collectively about 25%. And then really since then, we've been on a really nice rising market, up 51% on the S&P. That's great. But at what point will we have, like we had this pullback here in 23, it was a 10% pullback. And these pullbacks provide an opportunity to buy into these companies that you really like. You just have to be patient and have capital available. And I got to a position of 16% cash before yesterday. Yesterday, I probably invested upwards of $8,000 to $10,000. So maybe that brought it down to 15%. So it's good to have cash to invest when you have these drops. Now we have a little drop right now. How significant is it to this point? We're down on the S&P 4.29%. And again, this is not like spread evenly across all stocks. Some stocks are down much faster, like Ford is down big today. And that's where the opportunity is. For example, Google dropped 5% yesterday. I'll buy shares. Thank you very much. Google, in my opinion, is going to be worth a lot more money over time. It's one of the great companies. It's in the green in my quadrants of desirability. So it's a very good comment to, hey, have some cash, because buying at the top, like around here, is tough, because sometimes you buy a stock and then it begins to drop and it gets frustrating. So good comment there. All right, Sergio, you're all over the board today, buddy. Thanks for tuning in. Thanks for all the questions. Take a look at MU Micron. So Micron is a beneficiary of the data center build out that is been really hot because of the AI build out. Now it rose big time. If you look at the beginning of 23 to the peak, 182%. Woohoo! Rock and roll. What is that, about a little over a year, which is great, but It went up really fast and it's coming down really fast. It's down 24%. Now, um, I've done multiple videos on the AI hype, and I think AI is interesting and certain use cases are going to be very real. But overall, prices are too high in semiconductor. I have shorted NVIDIA, Broadcom, shorted other data center build out stocks that are in there. And I'm doing really well with those short positions. So for me, Micron, I would be very careful. If you're thinking of buying Micron, I'd be very careful. I'd want to understand where are these guys going to be. Like, if AI is everything, like the way semiconductor stocks are priced, everything anybody has dreamed of for AI is going to happen. Well, seldom does that get proven out. I'll give you one example. Self-driving cars are going to be exciting. That's a AI business model use case that I think we could all get our heads around. Okay, you get in the car and the car drives itself from point A to point B, similar to an Uber drive, except there's no Uber driver. Well, our friends at Google have been working on that for like 15 years, and they are operating that business in some major cities like Los Angeles, Phoenix, San Francisco. They generated $375 million of revenue, and they lost upwards of, I think, 1.5 billion on that unit because it's really expensive to run these self-driving cars. So it's taken 15 years for them to get to a point where they are monetizing the service, self-driving, but it's not near profitability. It's not growing very fast because local governments are going to be like, hey, we don't want you to put like 1 million self-driving cars on our roads. There's going to be a permitting process. I think, governments are going to be careful not to do something that's going to be harmful to the general population. That's an example of how AI is probably going to be real for self-driving cars. But it's not going to happen in the next 15 months. It's going to happen over the next 15 years. And it's taking Google, one of the best funded, smartest companies on the planet, that long. You look at other use cases, it's going to be the same, where you don't snap your fingers and AI does everything. Where will it be used? There'll be certain places where it makes a lot of sense. But there'll be certain places where it's going to take a long time. Having said that, investors, I don't know if they've started to become frustrated with the lack of growth, or maybe the growth isn't matching the stock price, but we are seeing a pretty good pullback from Micron to Broadcom. Broadcom's another company that's like Broadcom. They were just associated with NVIDIA, so their stock prices just flew up. Well, to me, that's just too much hype being priced into the stock and an opportunity for me. And I'm not recommending anybody short any stock, but I shorted those stocks and I'm doing well with those shorts. So be careful out there. The Quags, Toyota took a beating. I sold my AT&T stock at 245. It's under, wow, good move. Yeah, car companies, man, the fundamentals look great, but I need to be realistic. And I just don't know that owning a car company, an automotive company, is worth it. I'm going to have to really think about that, maybe get out of my forward position. Compared to other automobile manufacturers, where do you rate Ford? So I think Ford is very competitive. I think their quality level, from an American car manufacturer perspective, the quality level is up there near the top. They also run their business with a high discipline level, and their balance sheet's good. I think their leadership's good. So overall, I think it's a good car company. But I just finished saying that, just the space itself isn't really well liked by the stock market. And I'm okay doing that, but there has to be a significant payoff. And I don't know if there is one right now with Ford. So I'm going to rethink that investment. All right, the dividend guy. Thoughts on Starbucks and then PZZA. So Let me start with the one that I don't know. So PZZA, Papa John's. Okay. So Papa John's, this is a restaurant stock, but it's a franchise of pizza delivery guys. Wow, look at this stock price drop. Holy smokes. It's really been dropping. I mean, during COVID, right, we were all ordering food to be delivered at our homes. So the stock really rose because they probably had really good revenue growth. And they certainly did. They went from no growth in 1819, and in 2020, when the pandemic hit, boom, hey, I'm going to order some pizzas from Papa John's. Their growth has really slowed. So I think investors are concerned that, hey, we're not going to see growth in this company. When we look at free cash flow for Papa John's, their free cash flow is, let's call it $96 million. And it's a I don't like restaurant stocks. I like Starbucks, and that's the one restaurant stock that I own. But the thing about restaurants is, they involve food. In the case of Domino's, they're more like McDonald's, where they have the franchises operated by a small business owner, and that's the part of the economy where people work really hard because it's their little business, and I totally get that. But that's not a lot of free cash flow. So if I even multiplied that times 20, I'd get to about, let's call it $1.9 billion valuation. And their current valuation's 1.33 billion. All right. So you can probably calculate a decent discount based on free cash flows. The stock is down big. I would think that this stock, and we're looking at their forecast, 10 analysts cover it. They think it's heavily discounted. I don't think it's heavily discounted, but I think there is a discount there based on free cash flows. They expect that earnings per share is going to grow in the future. I would try to rationalize, why are earnings going to grow in the future? Is there something that I don't know, like everybody is going to fall in love with pizza again? Why is there going to be, see, we could explain why 2022 and 2021 were significantly higher. We had COVID, everybody was at home ordering a pizza and saying, hey, I can't go out to eat because the restaurants are closed. So I'm going to order a pizza and watch some YouTube and eat a nice pizza. Okay, I get that. What's going to happen to move the earnings per share in the future? I don't totally believe this forecast. So this is not the right investment for me, but my opinion is that you could probably calculate a discount based on free cash flows, not a big one. I don't think this is going to be hey, you're going to double your money in a year or two situation. And the market is not liking the Papa John stock. I'd compare it against others like our friends over at Domino's and Pizza Hut, which is owned by, I think, Yum Brands, and kind of see, which, if I do want to own a restaurant that does pizza delivery or delivery predominantly, let me own the one that has the best fundamentals and has the best story going forward. I'm not a buyer into restaurants. I just don't think it's a great business. When I look at the desirability zones, I put restaurants here. And the reason for it is, let's talk about Papa John's. So just a guy who loves pizza and believes he has a great recipe for pizza. He works for 10 years, saves up, I don't know, a couple $100,000, and he can open a pizza shop. No problem. And he would be competitive, especially in areas where they're like, oh man, it's one thing to buy from the big franchises like Papa John's or Domino's, but Joe's Pizza down the street, he's an artisan, man. He really creates really good pizza. So you have immediate competition in your market from local competition, more regional competition. There's just a lot of competition. Also, you saw that they produce little cash flow based on the revenue size. It's just not a very profitable category, restaurants. You buy food, you prepare it, and you sell it to your customer. There's not a lot of margin. You have a lot of spoilage. You have to hire people. You have to, usually the people that work at restaurants, it might be hard to keep them employed because they want, they may not want to work at a restaurant for the rest of their careers. They might want to use that as stepping stone, and then go work elsewhere. So I put them in the red. So I try to stay away from restaurants. Starbucks, let's talk about Starbucks. Starbucks is probably more in the gray or slightly in the green for me. And here's why. Is Starbucks, it's a premium company, um, premium coffee company. And coffee is a different game. Coffee, you take beans, you grind them, you pour water on it, you put it in a cup, and you charge your customer $3 to $5 for it. And if the customer orders one of the fancy drinks, they're paying upwards of $8 to $10. That model is far more profitable. They also have their network effect where they have locations across the US, around the world. They innovated the application, the Starbucks app, where you preload it with funds. That's a great idea. They get to hold, and if you look at their balance sheet, they hold a lot of cash for their customers. Their customers then have a lot of loyalty towards Starbucks. So Starbucks has really been operating really well. They are a restaurant, but they're predominantly a beverage company. And the beverages in a restaurant are always the product on the menu that has the best margin, because it is just, water being poured over beans or other things. They do have a menu of food, but typically it's very quick serve food. It's food that has been prepared for the most part offsite, brought on site, and then warmed up. It's a different game versus, let's say, a Domino's or a McDonald's, where they are taking raw ingredients and then making something out of it, a hamburger, a pizza, or a salad. Those things are, I think, more complicated. And Starbucks has a model that's more profitable. So that's why I'm an investor in Starbucks. I like Starbucks. I think Starbucks recently has been sold off. And one thing I read a book, a Pat Dorsey book, and I really like his approach. He's kind of a modern day Warren Buffett or modern day Peter Lynch. And he said something that really stuck with me, which was, you can easily change a management team versus changing a business. You can't take, let's say, a struggling business, let's say Ford. You can't say, okay, well, Ford's struggling, their stock price isn't, doing great, so I'm going to turn it into a pharmaceutical company. That's just nearly impossible. You're better off starting from scratch and just getting capital and starting a pharmaceutical company. So changing the business is very, very difficult. Changing the management team in proportion to what I just shared is easy. You just flip over to a new management team. And right now, the Starbucks management team is being questioned. I have no negative opinion on their management team. I think they've been operating the business. Maybe they made a few missteps, maybe. Same thing with PayPal. But in general, the business is really good. I'm very attracted to the business. And right now, the business is being sold off and at a very low point. They pay a nice dividend. If we look at their cash flow, they generate very good cash flow. And the cash flow looks great. If we look at $4 billion a year, we get to around the number that the company is being sold at if we multiply it times 20. The forecast is, analysts, 20 analysts cover it. They're slightly a buy, and they're saying that the price is discounted by 23%. Now, I put Starbucks right, kind of like halfway between the gray and the green, because their brand is number one brand in premium coffee. They have a model that I really like. They have the network effect. They have high loyalty. It is a way for people with discretionary income to kind of reward themselves in a simple way. Hey, I'm going to go have a nice Starbucks. Okay, cool. So all those things I like. So I like the business. I want to be a part owner in the business. The forecast on revenues, when I do my valuation, and they're priced at $74.89. So when I look at Starbucks, it doesn't provide a massive discount, 38%, but that's a really good discount for me because I'm buying the leader in their space. They're leader in their space for a business that is desirable to me. So I'm a buyer of Starbucks. I've been buying into the stock. I own, how much do I own of Starbucks? So that's the one restaurant. I own $15,355 of Starbucks. I'm sitting on a 3% loss. I continue to buy shares because I believe in that company. Ford, let's see how much money I'm going to lose today. So before today's stock price, it was $24,800. After today, I'll probably own $22,000. I'll still be sitting on a slight gain, but I think I'm going to rethink my investment in Ford and have an exit strategy developed. Back to Ford, this is why I created this desirability quadrant, because I read books, I think about process, I think about what's the best investing strategy. And my best results are when I find a company that belongs in the green early. I find a company that people don't understand, investors don't understand early, and then it's a big payoff. TSM, Broadcom, I made a lot of money on those two. Airbnb, Meta, I bought big into Meta in 22. It's been a great winner. Coinbase, I'm up big on Coinbase and so forth and so on. Versus, Ford is in the gray, and I would say that they're kind of in the gray with a little bit of in the red. So is it going to be more of a distraction than a performer? So I have to ask myself that and see if I really want to continue to be a Ford stockholder. We'll see. All right, so let's keep rolling. Shadow Guy, not Motel 6. Yeah, so I don't stay at Motel 6. I will stay at a Motel 6, by the way. But if I'm traveling with my lovely wife, it'll have to be a Marriott. If I'm traveling with one of my sons, man, we'll sleep on the floor of a Motel 6 to save a few bucks. Chipotle, Octopus Red Wing. So Android PC gameplay, good to see you. So let's take a look at Chipotle. So Chipotle is one of those stocks where, I would say that I had a few experiences at Chipotle over the past year where I was kind of grossed out. I thought the restaurant, especially, like the bar where they serve the food, was overly messy. And I'm like, dudes, that's food. That's food that you're about to serve me. And I kind of walked out of the place, and it gave me a bad feeling about the company. I've been to Chipotle a few times in the last, call it 2 months, and I've been very satisfied. I think it's a very consistent, experience. I had those experiences maybe 4 or 6 months ago, and hopefully I don't see that very often. So they have their business. They have grown. It is a growing business. It's a restaurant. I already told you many comments on the restaurant business, what I don't like, but these guys grow. Okay. They grow, and it's very good growth. They have a pretty significant market cap of $69 billion. When we compare that $69 billion to their free cash flow is $1.3 billion. The best valuation that I can get to for our friends over at Chipotle would be like 30 billion, maybe 40 billion based on free cash flows. And that's really put myself out there, because are they going to continue to grow at this rate? Right? Maybe. It's just hard because their model, you have to put a lot of capital into the business where you set up new locations. You have to hire people. That's hard. It's really hard right now to get employees. That's a reality. Is there's a shortage of employees. It's very hard. So I think there's a lot of risk factors out there for Chipotle. I'm not in the stock. I know people have done really well in the stock. I mean, look at the chart. If you bought Chipotle in 2020, congratulations, you did really, really well. It's just, I like staying in my lane. There's certain industries where I've done well, and I'm going to stay in those industries. Food companies, I as a youngster, I worked at a Taco Bell, I worked at a pizza shop, and it was interesting, but I got different jobs as soon as I could because those jobs are really hard. Really shows you that, restaurant employees deserve a lot of our respect because they work so darn hard. I worked there and it was a job that I had as a youngster and I moved on. Um, but we'll see where Chipotle goes. Over the past month, it's had a pretty rude ride. It's down, 22.75%. So it's had this really up and down experience here in year to date. So those are my comments on Chipotle. All right, so I'm going to end the call very soon. So I've looked into Samsung and it just I didn't see enough of a discount. I think it's a very diversified company and it's interesting. I mean, they're into all kinds of stuff. They're smartphones, they're a semiconductor company, they do appliances. I mean, they're all over the place, which is really impressive. But their stock is hard for me to get into it. I've looked at it a few times. Maybe I should analyze it on another live stream. Oh no. Well, good luck. I hope that I'm wrong. I don't claim to be right all the time. And Ford could really start rallying. I'm just seeing the space for automotive. It's just holy smokes, man. They can't catch a break at times, and I think we're in a period like that. But I hope I'm wrong and that you make money on that. GDP data is out. Yeah, so we covered that a little earlier, and I mean 2.8% growth. That's decent. It's not bad. And would the Federal Reserve be inclined or be in a hurry to reduce rates to really prop up the economy? Well, this is evidence that they don't have to. So that's why I think when we look at I think we saw the Russell. Well, now the Russell's bounced back. All right, cool. Go Russell. Looking at the markets, the Russell's bounced back. The NASDAQ is down 1% again. Man, the NASDAQ is down. Let's take a look at from its peak to this point. It's down 8%. We're nearing correction level for the NASDAQ. And it brings me to, let's take a look at the poll that I put out there for the channel where people are voting on where they think this correction is going to land. So we have 25 votes and 36% of people that responded said it's probably going to go down 15%. And this is the S&P. 32% down 10%, and then 32% down 7%. We'll see how far it goes, but overall, I think it's a good thing to have this pullback. We can't have markets just scream up and be going up forever. Looking at just the heat map for the market, semiconductors down, Google's down again. I guess I'm going to be buying more Google and more Meta. I shorted Nvidia. I shorted Broadcom. So I'm happy about that. I'm buying into Intel. Looking at these, I'm buying into Adobe, and they're up a little bit today. The drug companies are holding their own today. I'm a buyer and owner of Pfizer, and I continue to buy shares on down days. So I'm glad to see that's up. Novartis, we covered yesterday. It's up. So what's doing the best here? It looks like software applications are having a good day, up 1%. Regional banks are having a good day. Aerospace, up 2%. Interesting. And then telecom, I'm not sure what they're up. Not sure what that's up. So it's kind of a day for the smaller caps. Look at that. The smaller the box is, the lower the market cap. So these green spots are companies that have lower market caps. So that the rotation of money out of big caps into smaller caps. You're seeing the evidence of it just at this moment, but we also have seen it over the last 2 weeks. So we'll see if it continues. So yeah, Mike, BMY is Bristol Myers, and they're in this space here. Are they listed here? I think this one's it. Nope. Here it is, Bristol Myers. So Bristol Myers is up 2.47. Very nice. And every time I look at Bristol Myers, it looks like a good investment. I'm a Pfizer investor. I invest in United Therapeutics, Catalyst Pharma. So I'm good. I'm good in that space. I can't buy anymore because then I'd be like, man, my whole portfolio's in life sciences and pharmaceutical. But I think Bristol Myers, every time I look at them, they look good and they have a good dividend. So Nvidia's down almost 5%. Well, that really breaks my heart because I shorted it. I have both Pfizer and Bristol Myers. I mean, the healthcare space, has surprised me over the last 2 years. It hasn't done well. Pharmaceutical companies have not done well. And I scratch my head and go, why? It's not that we have an administration in government that's anti-pharmaceutical. Yeah, they put a lot of pressure on them to make sure that they have good drug prices. But in general, like Democratic leadership tends to provide more healthcare services to the needy. And they should be benefiting Pfizer, Bristol Myers, and other pharmaceutical companies. So it's been kind of a riddle that I haven't been able to figure out to this point, but they're beginning to do something here in 2024. And I hope they continue to do so. So it's going to be an interesting time. And it's a time, that analysis really does matter as we look at, where to invest our hard-earned money. I really appreciate you joining the live stream. I appreciate all the questions. Let me remind you, I'm going to do a live stream on Saturday. It's going to have to be an early one because I've got a godson that has a birthday, a second birth, or he's going to be 2 years old, and I'm looking forward to it, which consumes my late morning. So I'm going to do an early morning live stream on Saturday. I welcome you to join. We'll talk about the market. And then we're going to do the video conference again this Sunday. It's already scheduled. And everybody who said they'd like to attend, has given me their email. They're invited. If you want to attend that, please send me an email and say, hey, I'd like to attend 10 a.m. Pacific, and email me at victorhinvesting@gmail.com, putting it in the chat so you guys have it. And, if you'd like to join on Sunday, it was a really good session last Sunday because in this format, I love your comments over the chat. Awesome. But the live with, interaction is that much better. So if you can, please attend. I know the time isn't perfect for everyone, but I got to pick a time, and I can't do it in the afternoon because I tend to have family events, and I'm sorry if it interrupts or, something else, or you can't make it for some reason. You could always watch it. I'll put it on the channel, the recording. So with that, let's see where the market heads today. Thank you so much for attending. I appreciate it.